Hello, I'm Dave Rudd of Sigma Sandbox, and with me is James Ryder of fxvolresearch, and we are going to talk about uh, blending of CTA portfolios with equities. James?
Yes, just to go back, I basically work as an external marketer for a number of CTAs, and I've had a very long interest in finding ways of combining them to optimize, not, I shouldn't say optimize, but to enhance the risk-adjusted return and to mitigate the drawdowns. So this has been something I've been interested in a long time, and I've gone through a number of different iterations, and I've looked at a variety of different strategies. And sort of the current managers that I work with at the moment, I've noticed over time, just by intuitively looking at their returns, that they do tend to not to be as correlated as one might expect in the CTA space, because they are doing a number of implementing a number of strategies that are in some ways unique and not characteristics of the rest of the space. So I wanted to, when I met with David, I wanted to actually use his software to actually come up with something that reaffirmed what I already suspected intuitively. And that was basically how to take these three managers and combine them, and then to combine that portfolio with a portfolio of the S&P Total Return Index.
Right. So these managers are they're definitely doing different things as by their descriptions. And I just wanted to note one can take that return history. And by the way, these are VAMIs, which is how much they've made or lost over a period of time. And you can look at various periods and see how they've interacted. And it's fairly seamless. And you can do this with equities and hedge funds and ETFs, et cetera, as well. But that's the common return history of these. Sandbox always picks the common return history. I think one of the managers has a longer return history here, but we do pick the common period.
Right.
Okay.
The other thing I wanted to point out is that when I sort of started doing this investigation on my own a number of years ago, I talked to people in this managed futures space, and basically many people sort of reiterated to me that you don't want to try to get too cute with the data. In other words, you don't want to optimize the data that you have or curve fit it. And I basically, in order to maintain that strict discipline, I basically wanted to make all of the allocations equal and go through a rebalancing process that was the same. This was actually this topic of adding CTAs or systematic managed future strategies to the S&P or to any equity portfolio. It was a topic at a recent hedge fund conference that was sponsored by SocGen. And they went through an analysis that went back to 1992. And this analysis goes back to 2005. That's the beginning starting point for where they have a common overlap in terms of return streams. But in my opinion, and this is just my opinion, any return stream that's like at least 15 years or longer becomes statistically significant. And in my opinion, these returns do meet that minimum criterion. So whenever you want to drill down and do due diligence on it, you have an awful lot of data to work with.
Right.
And you can easily find out from doing that, from drilling down into particular periods, you can easily find out what was the market environment in which this strategy did extremely well.
For sure.
Where did it lose money? Where did it tread water? And basically, if you do that analysis enough, you'll basically get to a point where you develop an intuitive understanding of how the returns are being generated.
Yeah.
And obviously, with these three managers, you don't want their correlations to be with each other to be that high. If you're trying to enhance the risk-adjusted return.
Absolutely. So we can look at for any period on with these three managers, we can check correlations, and it varies depending when you look,
Right.
and so you can see here they change significantly. So some of the correlation, I wouldn't call it spurious, but it comes and it may go, because they are doing different things.
Right. And they're also, I mean, the other thing I wanted to, not just to look at their raw correlations, but I wanted to see the way that capital is allocated and what are the time frames in which the time horizon that they're trying to capture this alpha from. So one of the managers has a very short window. He's basically in the short-term space.
Yeah.
He basically operates on a thesis that returns in the financial markets are determined by the level of risk appetite. And he basically goes through a process of creating an index of measuring a number of fundamental data points. For example, like bond volatility, swap spreads, FX implied volatility, et cetera, credit spreads. And he puts these together in such a way as to come up with an index of to what extent is the market risk seeking or risk adverse. And that's core thesis is what you have to buy into in order to go into the rest of his process in order to buy. But if you don't buy into that core thesis, then that's the end of the discussion, in my opinion. You have to basically believe that he has basically come onto something in terms of allocating capital based on a risk appetite that is statistically significant. That's basically what makes him fairly unique. The other manager is a medium-term manager that's basically using what I would describe as digital signal processing. It's a way of stripping out noise from signal and analyzing data series, high frequency data series. And he's also using, a little bit more controversially, he's also using pattern recognition, primarily for helping him get out of trades. And the last manager, the manager that I define as niche, is basically a classical trend following model, and he's using mostly momentum models to determine. And the other thing to determine his capital allocations. But the other thing that differentiates these three managers is that they are differentiated in terms of their levels of the number of markets that they're looking at. The short-term manager is only looking at 30 markets, and that's sort of more or less inevitable when you're looking at the short-term space, because he needs lots of liquidity to get in and out. He can't really get involved in less liquid markets. The CTA one, the medium-term one, that's basically using pattern recognition and digital signal processing, looks at 125 different markets. And lastly, the final manager that basically I call a classical trend following manager is only looking at 75 markets. But he's also, this makes him a little bit unique. He's looking at markets that are less liquid, like smaller commodity markets like lumber, cocoa, coffee, stuff like that bigger managers can't really allocate to.
Because some of those have been amazing markets, that's for sure.
Right. So that's how I differentiate in terms of process, investment style, time horizon, and levels of concentration.
They seem to complement each other. I want to reiterate that this red line is the average. Basically, if you'd invested an equal amount on day one with each manager, that's the resultant portfolio. If you'd invested $1,000 and split it amongst the managers, you'd have 6,500 today, or when this closed. So, and these numbers on the right are reflective of that portfolio. So as you change the weightings, if you wished, you wanted to be cute about it and change the weightings, the statistics change to some extent, but also, volatility changes as well. So,
right.
Yeah.
Okay. Yeah, we haven't gone through any sort of, by keeping everything equally distributed, we're not engaging in any form of optimization. And we're not basically making bets about which manager will do better in the future either.
Right.
Cool. But I think once you get to that point of understanding the returns on an intuitive basis, and you understand the markets, like for a classical trend following model, it's very easy. It's not hard at all. You know, if the returns came from cocoa, all you have to do is look at a chart of cocoa, basically.
Yeah, for sure. For sure.
But for the short-term manager, it's a little bit more involved. It's going to take time to find out. And the other point I want to make about the due diligence process is that some people have characterized CTAs as black boxes, as sort of because they're rules-based systematic. But in reality, if you go into any sort of due diligence process with any of these managers, they should provide you with a very high degree of transparency about the granularity of returns. They may make you sign some sort of NDA, or they may try to say that there's some sort of secret sauce that they can't reveal. But basically, if you get down to the level of granular attribution in terms of where the returns are coming from, you'll get a much better intuitive feel for what they're actually doing. And it'll become much more transparent, I think, over time.
Great. So now we have to discover how this is complements equities, generally speaking, I guess.
Right.
This how do you want me to just, I can actually move the S&P ETF into this and equal allocate, or we can do weightings here, or move to a comparison chart. What would you like to do?
Sure. Let's do the chart first, and then the comparison second.
Sure. So a simple one. You had used the idea of a 50% allocation to the S&P, and basically equal allocating to each of the CTAs, I think.
Right, as close as we can get it.
Close as we can get it, yeah. 17, 17, and 60.
Right.
Okay, great. Roughly. I could type them in, but I guess there we go. Close enough. I'll type them in. I'll type them in.
Sure.
16 and 17. Okay. Now that red line is reflecting this portfolio. 50% allocation to the Spider the S&P SPY, and the balance of 50% is allocated almost equally amongst the 3 CTAs, and that is a very smooth VAMI line on a portfolio. Absolutely.
Right, and I think if you do you have it set up so it's rebalancing annually?
This is not rebalanced yet. Annual rebalance is there.
Right.
Yeah. Okay.
So then now you have a return stream that it's actually beating the S&P on an absolute return basis.
Right.
It also has a maximum drawdown that's only 11%.
Yeah. So let's look at the compare to tool. Right. So here's the CTA with a 1-year rebalance. The 3 CTAs with a 1-year rebalance, and compared to, again, the SPY. Again, they almost look, they're not negatively correlated, but
yes, there are definitely, I mean, there are definitely periods of negative correlations that basically are most pronounced during periods of equity market stress, right? Whenever you have them.
Sure.
But there are also periods where CTAs and equities can be uncorrelated and positively correlated as well. So it by adding this to your portfolio, you're not just getting some sort of portfolio insurance, you're actually getting a wider array of returns that are primarily coming from markets that are not necessarily correlated to stocks.
Right. Absolutely. Would it be worthwhile to look at those three CTAs and look at the wider world to see if that combination, that basic combination of CTAs is actually if it has market correlation? It would
Sure.
be interesting to take a peek. So we have a tool here called Finder, and what Finder does is it basically takes the return stream. This is the return stream of the three CTAs that are in Portfolio Builder. Equally weighted. So let me just redo that. Now three that are equally weighted. And then what we do is we ask Finder to search. That's the return stream from three equally weighted CTAs going back to 2000 and roughly 2005. So we ask Finder to go out into the world of ETFs and search all. Well, there are probably 6,000 ETFs. But first of all, it has to search. There weren't so many around in 2005-06. So of the ones that were around, the most highly correlated ETFs are listed here. And as you commented earlier, James, they're gold, metals, which is interesting, and a variety of product. Those are not high correlation numbers. As we start later, so let's say we invested in began to invest in these CTAs, say in 2012 or something like this, and we run it again, and we search the world for all ETFs that have a history that's at least going back to 2012, we find correlation jumps, but it's still extremely low, in my opinion. And a lot of them are there'll be some negative correlation here as well. We run from about 300 ETFs in 2006 to a few thousand that it has to search now. But none of these are highly correlated to this portfolio of three equally weighted CTAs, which is encouraging. That's for sure.
Right. Right.
Okay.
I mean, CTAs, it's important to understand. I'll make some general comments that I'm sure people will disagree with. CTAs generally suffer during periods of compressed volatility across financial markets and commodity markets. They struggle. They can go through a period of like 2 or 3 years, of which it's sort of like death by 1,000 cuts. And they can experience drawdowns. And one of the advantages of this combination is you're reducing that drawdown. The drawdown of the three CTAs combined is like minus 18%, versus the S&P, which is the S&P on its own is minus 50% or something like that.
Absolutely.
But it's important to understand that CTAs can are sometimes they get classified as being similar or to global macro, and global macro may well be involved trading futures contracts or the same asset classes, but global macro is basically a discretionary process. I mean, if you I think we've all read, the books about great global macro traders from the past, like Druckenmiller or Soros or etc. Or and we all know these great anecdotes about let's take on a huge position in the Deutsche mark or whatever. That's not going to happen in the CTA space because it's a rules-based investment process. They're only going to leverage up a position once it's already deep in the money. Once a very clear trend has been established, and they already have the P&L to back increasing it. So it's one of the. I don't have anything against the global macro space. I think it's fine, but one of the prices you may pay for having a higher absolute return is you're giving up a lot more volatility in exchange for that, because they start out on day one with a highly concentrated series of bets about equities, commodities, fixed income, and they're not they're not just letting the model tell them how much to allocate. They're doing it on. So I think that that's an important distinction, that because this is a rules-based process, they're not going to have that. So the corollary of that is that because CTAs go through a process of filtering their capital allocation by the level of volatility, both at initiation and while the trade is on, they're very good at targeting volatility.
Yeah.
I mean, that, if you want to, what a CTA is really good at is they really are good at targeting volatility. And if they're trying to set out to target a generally speaking, they're trying to set out to target a volatility that's comparable to equities, which the long-term stock volatility is around 15%. And CTAs generally are trying to mimic that, or obviously come in at a lower volatility. I mean, some of these managers, I think, may well have lower volatilities going forward. And that's what that's what the institutional market wants, right?
Right. Yeah. So it's
Generally,
been said to me that CTAs, you don't want to, by definition, CTA has no conviction, which
right,
some people find disconcerting.
right.
But at the same time, they don't attach any particular loyalty to a theme or an idea.
Right.
It
I
has
mean,
to prove itself.
yeah, I mean, sort of long only managers can only be long.
Yeah. Yeah.
Right. So, or the other way I wanted to phrase it, it's just suppose you came across a portfolio that was heavily weighted toward alternatives, toward CTAs, global macro, fixed income arbitrage. It was very heavily weighted. The ideal allocation for that portfolio would be simply equities.
Yeah.
I'm just trying to say the same thing in a different way.
Yeah.
Equities would be a risk-reducing allocation to that portfolio, is what I'm saying.
Fair enough. Yep. There you go. That
Right.
makes perfect sense. Absolutely. Well, that is those three CTAs on their own. This combination is remarkably smooth the volatility while doing substantially better. It's a nice portfolio, and tie that in with the S&P. When we see that those three managers generally have a return profile that is very complementary to the S&P. Those three managers.
Yeah. So the combined portfolio of CTAs plus the S&P has a volatility of 8.2% and a return of 11.1.
Yeah. Yeah.
So if you're an institutional pension fund, what do you want to? You want a return that's somewhat. Generally, they're shooting for a return of around 6 to 8%.
Right.
And they want a volatility around 10 to 12.
Yeah.
That's why, to some extent, on basis alone, they might tend to shy away from CTAs.
Yeah. Yeah.
CTAs generally, if it's a volatility that's comparable to stocks or higher, they might shy away from it. There may be other reasons. I mean, if you define an investment as a series of future return that's positive, but also a series of regular cash flows, CTAs, don't meet that criteria. There have been people who have tried to suggest, like the roll yield or the future strip or the interest rate differentials can provide a regular form of something that's equivalent to dividends. But in my opinion, they're not stable, nor is carry as a trade. It's not stable. It may look like a dividend for some time, but it's not really. So you should make a distinction between really traditional investment strategies, which would be high quality stocks and bonds or government securities, and those type of investments that have a positive expected return. And CTAs definitely fall into that latter category of having a positive expected return, and as also acting as a powerful diversifier.
For sure. Cool. Fantastic. I just wanted to point out, if I can,
Sure.
we just run viewers through this Sandbox. So we have this builder correlation matrix that can examine like a 50 by 50 matrix solver, which is basically does analysis on on various portfolios and will suggest weightings. Finder, I chatted about already, compare to tool. It's just a simple comparison. We run a very interesting efficient frontier, which rather than, it looks at every possible combination. And we cover the data is equities, hedge funds. Nordic Hedge has supplied their information of 2,500 hedge funds. Canada and US ETFs, Smart Beta from QMIT out of New York. US and Canadian mutual funds, a lot of interesting benchmarks. And then you can load your own data in here as well, both quarterly and monthly. If you load quarterly, we decompound it into a monthly return for analysis. So you can put in private equity and or other information and see how it stacks up, or how it's complemented by other information we may have in the database. This is all complementary, and if you have a particular database you're interested in that we don't have, please let us know. Great.
Perfect.
Great. Well, listen, thanks, James. I appreciate your time and your thoughts.
Thank you.
On CTAs. I've been following them for a long time, and you did a nice job.
Thank you.
Okay, great. Thanks everyone for joining, and reach out to James for more information on those CTAs. That would be great. Take care. Chat soon, James.
Cheers. Thanks again for your time.